And on that note, let's bring in Schwab's Kevin Gordon and Cameron Dawson of NewEdge Wealth to kick this around. Cameron, I'll turn to you first. Is that priced in to the market right now? A mild recession?
No, not at $220 a share in earnings, trading at 18.5 times those earnings. If we have a recession, that 220 is too high. It likely looks something like 200 or lower. And then we would likely want to put something more of a lower multiple on that initially, just because you have the de-risking that happens when you have uncertainty about future growth. Term premium goes down. So I don't think that at this level, the market is pricing in a recession.
I mean, when you hear that coming out of the minutes today, and then you have Fed speak like you did today that says we need to do more. We really don't care. We're more concerned with inflation than we are in the economy. And I think that's kind of the message. And I felt like, and I mentioned this earlier, when Sarah Eisen asked Barkin directly that question, whether you're now in the soft landing camp or you still think you can get a soft landing, he didn't even answer the question with that. He said, we're focused on getting inflation down.
It speaks to what they're willing to sacrifice in order to get inflation down. In their own forecast, they have unemployment going all the way up from 3.5% today to 4.6% by the end of the year. That means that, in theory, if we take them for their word, they would tolerate a lot of labor market weakness before they would even act to ease policy. So that tells you they think that they still need to see a weaker labor market. They still need to see weaker demand. That was the comment from Barkin today. Less demand, so we'll watch retail sales very closely before they even think about easing policy.
To me, Kevin, the market reaction today, the price action from 2 o'clock forward was so telling. At first, you see the market look like it was going to have a bit of a rally, and it started to rally, and I'm like, all right, I totally get it. Market thinks that, okay, the Fed is not going to be able to, who cares what they say? They're not going to be able to do anywhere close to what they still suggest they might, because the economy is going to be too weak. And now I go back to, okay, well, bad news might be bad news again for at least this moment, because if you think we're going into a recession and you don't, like Cameron said, think it's priced in, then where do you go?
Yeah, I think that's a right way to think about it, where relative to last year, we're shifting away from kind of inflation being front and center as a concern for the market and slowly moving towards labor and then the broader economy. I think one way to look at it is even the retracement in yields today kind of picked back up after the initial drop from the CPI report. But, broadly over the past couple of months, you've started to see a reconnection in bond yields and stock prices. Most notably, when you move actually up the scale, up the cap spectrum into things like mega cap tech. I think that's a more telling signal, not something that we think will last in perpetuity, but a more telling signal that if you have that reconnection and then you go into slower growth, yields will be falling for the so-called wrong reasons. With growth actually slowing, us getting into a recession, that probably puts more downward pressure on the stock market. So I think that's the right way to think about it.
If there's more downward pressure, because I've had a lot of different predictions this week alone. Some who suggest, well, we're going back to the October lows. We're going to retest that. It's just a matter of time. From others who say we may have a pullback, but we're not going that low.
Yeah, I think it depends on the part of the market you're looking at. There was a lot of enthusiasm about how much, how strong year-to-date gains have been, but it's been driven by a handful of stocks, just really a small sliver of sectors. But if you kind of go one step below the surface, look at the sector level, and then another step even at the industry level, look at the banking index, even the regional and the small banks, they haven't gotten any kind of a lift since the huge drawdown in March. You kind of need that to work in conjunction with other cyclicals in order for the market to kind of find its legs again and keep going. I think that the deterioration in breadth over the past couple of months has been a pretty strong tell that, participation has just looked relatively anemic, both on the breadth side, but also just from an investor enthusiasm perspective. You hadn't seen really any flows into equities. It's really shifted mostly into the bond market.